Hey everybody, how's it going? Hopefully you're all having a great day. In today's video, I wanted to answer some of the most commonly asked questions online about finance. And I got these questions by basically just typing in ChatGPT, what are the top 7 most asked questions, and spit these out. So hopefully one of these 7 answers a question that you maybe have asked or you have. And if it didn't, feel free to ask a comment in the comment section, and I'll be happy to answer it for you in the most objective way that I can. Without further ado, though, let's get into it. So the first question is, what is a stock? Fantastic question. It's actually a question that I get asked a lot from a lot of my friends. Now, stock is synonymous. You may hear equity, you may hear stonks, right? You may hear shares of a company, right? All that to say, when you own a stock, when you own an equity, when you own a share in the company, when you own stonks, you own a percentage, albeit a very small percentage, but you own a percentage of a publicly traded company. Now, with that ownership in that company, it entitles you to a few luxuries, like if you were to ever want to vote on company matters, you actually do possess the ability and the right to vote on matters that they're voting on. Now, your vote will be obviously proportional to the share of the company that you own, right? So if you own 1/100th of a percent of the company, your vote means that much, but you still get the vote. So with this ownership of the company, you basically participate in the positive performance and negative performance of that company. So if in the public's eye, that piece of that company, right, whatever 1/1,000,000th of that company, if they think that that becomes all of a sudden worth $30 more, $50 more, your share of that company increases that much value, right? So, and the opposite is true as well, right? If everyone thinks that your share of that company is worth like $50 less than it is today, no one's going to want to buy it at that price, right? So the value of your stock can fluctuate with public opinion on what that company is worth, right? Now, you might be thinking, okay, well, like, I get it, cool, like I own a part of that company, but like, how does that even get sold? Like, okay, don't worry, I'll answer your question. So when you have a business and you're kind of running things on your own, right? You're putting your own money into it, you're scaling up operations. At some point, you may want to get some more money in the door so that you can grow your business even more, right? So some very, very smart people, right? Some people may say like smart people, some people would just say smart people. Whatever your opinion is, somebody comes in and values the company, right? They look at how much you're making, they look at the land you own, they look at the materials that you have, they look at the machinery that you have, and they value it. When they value that company, they basically say, okay, you're going to go to the public market, right, the stock exchange, and you're going to basically sell whatever percent of your company, and that percentage is going to be represented over, like, let's say 1 million shares or 2 million shares or 10 million shares, right? All of that is agreed upon in the written agreement, and then they do what's called an IPO, or an initial public offering. So they pick a day and the stock goes live and you can buy it in your brokerage account, right? Which we will also discuss later. And the prices fluctuate, right? They may have guessed that each share is worth $50, but if the public thinks like, oh my God, it's that company, they're finally public, $500, right? And everybody buys it for $500, then those shares of that company are now worth $500, right? So that is kind of like the base of what a stock is. It is ownership of a company. You own a percentage of that company. With that ownership, you get the right to vote in that company. You participate in the company's growth, and you also participate in the company's not growth, downsizing, right? Whatever the case is, poor performance, right? Which is a bit different than what a bond is, right? Now you may be thinking, what's a bond? Fantastic question. It brings us to our next question. What is the difference between a stock and a bond? Well, we now know that stocks are ownership of the company, right? It's a small percentage, albeit, but ownership still, right? A bond is not ownership in a company. A bond is basically the company giving you an IOU, right? So bonds are debt, right? So when a company issues a bond or when they sell a bond, and they are asking for money, right? They're saying, hey, we're looking to enter a loan basically between us and somebody else, right? We're going to sell you this bond, and on this bond, you're going to have a whatever percentage, right? It could be 6%, 4%, 2%, whatever the case is. It's the interest that they're going to pay you for letting them borrow your money. This is referred to as a coupon, right? So they may have you can buy a bond for $1,000, right? And they're going to give you a 6% annual return, or 6% interest, or a 6% coupon. They're basically saying, okay, if you give us $1,000, we'll give you $60 every single year. And usually the bonds will have a date at the end of it that indicates the day in which they will basically give your money back, right? So if it's a 10-year bond, and it's year 2023, it will be a 2033 bond, right? So over the course of 10 years, they get to keep your $1,000, and in return, they're going to give you $60 every single year for 10 years, right? So you get $600 for doing that. At the end of that 10-year period, they give you your $1,000 back, right? Because they borrowed your money, right? You didn't invest in them. You didn't buy a share of their company. They just flat out borrowed your money. And they're going to give it to you back, right? How trustworthy the company is to give you that money back is known up front, right? A lot of agencies will rate these. Why it's not known for sure that they're going to give you your money back, but there's the likelihood. The likelihood is known, right? So bond rating agencies like Standard & Poor's, Moody, they rate different bonds. So they look at a bond and say, that company with this thing, with that thing, they have this many people who are backing their bonds, which means if they're not able to meet the bonds and pay them all back, those companies are willing to step in and, also pay it, right? They'll basically rate how trustworthy that bond is, and they'll give it a rating. And if the rating is higher, and if they think that, the likelihood of them paying you back is higher, you'll tend to get a lower rate of interest because there's no risk involved, right? Or it's seen as a less risky investment. Therefore, the normal investor is willing to take less interest for a more assured payback of principal, right? Now, if you're not highly rated, you may have to offer a little bit more money to incentivize people to let them borrow your money, right? So if somebody is maybe 80% sure that they're going to pay you back, 6% may not be worth it, right? You may need 8%, you may need 9%, right? But that's all up to you, right? You have to go through and basically agree or disagree and not buy it or buy it, right? Now, that being said, if a company were to go bankrupt, now we're in a different situation, right? Whereas the stocks, you own a percentage of the company, you own equity in the company. Bonds, the company is in debt to you, right? You are much higher on the list if it was a total bankruptcy where they're just liquidating everything and paying investors back. As somebody who lent the company money, you're much higher on the list of paybacks than people who own equity in the company, right? Albeit, as a stock owner, you still are on that list, but very low in comparison to bondholders, right? So they'll do their best to pay back all the bondholders before they get down to the equity holders, right? So that's another difference between stocks and bonds. All in all, stocks are seen as a little bit more volatile, right? The price fluctuation of stocks is much higher than that of bonds, but the income portion of it on bonds makes it an attractive investment for some people, right? So on a small tangent, modern portfolio theory, people say, you should have a good blend of stocks and bonds in your portfolio. And that's basically saying a portion of your portfolio should be really geared towards being able to grow at a rapid rate, while the other portion just basically secures you some steady growth, essentially. So that's the difference between stocks and bonds in a very, very, very high overview nutshell. So hopefully that was helpful. If you have any questions on that, feel free to leave it in the comments. Now, stocks, bonds, all fantastic. How do I buy one of them, right? Fantastic question. The next question is, how do I invest in the stock market? First up, you need to open what's known as a brokerage account. Now, a brokerage account is very different from a bank account, right? A lot of people have bank accounts. Not a lot of people have brokerage accounts. What is a brokerage account? Well, Robinhood is an example of a brokerage account. Webull is an example of a brokerage account. You have the major players like Schwab, Fidelity, Vanguard, Merrill Lynch, right? All of those are different brokerage firms, right? So banks and brokerage firms are two totally different entities, right? They're regulated by different governing bodies. One, the bank, is solely for cash. You cannot buy stocks in a bank account, right? They have no way to broker the trade between a willing buyer and a willing seller. That's where brokerage accounts come in, right? Brokerage accounts are not allowed to hold cash, right? They are not a bank, right? They just broker trades between willing buyers and willing sellers. So in order for you to invest, you need to open a brokerage account. You need to deposit money in so that you can buy stocks and bonds or whatever you want to buy, right? Now you may be saying, well, wait a gosh darn minute, Sean. You just said I can't hold cash in a brokerage account. So why would I deposit money in there to then buy stocks? Do I have to buy it the same day? Am I like on a time crunch? Will I lose any money that I don't spend that day? Not quite. So because they're separate entities, brokers tend to partner with different banks, right? So for example, Charles Schwab uses Bank of New York Mellon. Bank of America uses Merrill Lynch, Merrill Lynch uses Bank of America if we're talking brokerage to bank. So essentially, you have Merrill Lynch, the broker, and you have Bank of America, the bank, right? Anytime there's money left in the brokerage account at the end of a day, right? They will move that money to the bank. Now, that doesn't mean you have a bank account there and they're moving money into your bank account. They're moving cash into a banking vehicle for that brokerage firm, right? And they have it down on a ledger like that's your money, right? So when you're logged in to your online brokerage account, you'll still see the cash is in there, but it's only like a visual placeholder because the cash is not actually in an account at the brokerage firm, right? Like it's in a banking vehicle. So if you look at your transaction history, you'll see like these small little transactions, say like brokerage sweep or something like that. And it usually shows as a negative, even though you have a positive balance in your account. You might be like, why is that? Well, it's because if you have a positive balance here in your brokerage account and they have to sweep that to the bank, let's say you had $50 in here, it's going to be minus $50 from the brokerage account and plus $50 in the bank, right? In the bank counterpart. Let's say you were to use money in the brokerage account. Well, obviously all the cash is here, right? So you're going to see a positive brokerage sweep because they're having a subtraction from the bank and adding it to the brokerage account so that you could then buy a stock or you can, send money out of your account, whatever the case is. But that is how you invest in the stock market. You open up a brokerage account. You can do Robinhood, Webull, Schwab, Fidelity, Vanguard, Merrill Lynch, really like there's a whole host of them, right? And then once you move money in, you open up a trading ticket and you basically put in the order. And different sites have different ways and like different interfaces, but it's all very straightforward. You just like click buy, you type in the ticker symbol that you want, or ticker symbol is like an identifier so that you can find whatever company you're trying to invest in and then hit buy, right? Very simple. Now we covered stocks, bonds, but what about mutual funds or ETFs, right? Another fantastic question. Let me answer it. So a mutual fund and an ETF are similar in some ways and different in others, right? Let's talk about their similarities. A mutual fund and an ETF is a way for you to participate in the performance of companies, but not own a share of that company, right? So let me break that down. When you buy a stock, when you buy equity, you own a very small percentage of that company, right? But you have to pay the full price for that share, right? So let's say you wanted to own, 3 of the top 10 companies on the S&P 500, right? You would have to pay it's like $600 or something like that. Don't quote my math there, but you'd have to pay basically like $100, $200 per share of each of those companies. Not everybody has that much money, but you still want to participate in the performance of that, right? You buy what's called a mutual fund or an ETF, and basically they're sold as individual units, right? So a very popular mutual fund at Vanguard is the VTSAX, which is the Total Stock Market Mutual Fund, Vanguard's Total Stock Market Mutual Fund, where each share is, I think, like $99 or something like that. So instead of having to pay $600, you now pay $100, and you get to participate in the performance of all of those numbers. So effectively, your 10 pennies of that $100 performs like this company, and another 20 pennies performs like this company, right? And if you go on Yahoo Finance and type in whatever mutual fund or ETF that you're looking to buy, and you go to holdings, you will see the percentages that that mutual fund or the ETF hold, each of those like positions respectively as far as percentages are concerned, right? So although you participate in the performance of that company, so if it's $100 per share of that mutual fund, so you would just buy like shares of VTSAX, right? Now you don't own Vanguard or anything like that. You're literally just buying a product of theirs, and it's worth something, right? But that performance does like participate with the performance of all of those other things, right? So you are not a shareholder, right? Just because your 20 cents or 30 cents performs like Apple does not mean you are allowed to vote at Apple shareholder meetings. So that's one of the differences between owning a mutual fund or ETF and a stock. Both of them have some of the performance of the underlying company, but when you own stocks, you actually get to vote. When you own equity or mutual funds, you don't get to vote. As you probably guessed, you're also not entitled to any sort of like liquidation event, cash, right? So as an equity holder or stockholder, you are entitled to receive some money from the company if they were to have a total liquidation. If you participate in the performance of the company through an ETF or a mutual fund, you are not entitled to any sort of like order of that payback list, right? So that's it. That 20 cents just went to zero, right? And that's it. So that's that. It's a way to diversify your portfolio, which is something everybody says, right? Like, oh, don't put all your eggs in one basket, diversify, right? Instead of like having to do research and find like 30 different companies to invest in, you could just buy one mutual fund and it does the diversification for you, right? You could buy one ETF and it does the diversification for you. You could literally put 100% of your money into that mutual fund or ETF, and you would be adequately diversified within that sector, right? So like, again, you shouldn't put all of your money in like the equity market if you believe in modern portfolio theory, which we'll talk about. Modern portfolio theory basically says you should own some portion stocks, some portion bonds, which you now know what both of those are, right? If you put 100% of your assets in stocks or the equity market, it's seen as a little bit risky. So if you put 100% of your net worth in like an equity ETF or an equity mutual fund, then like it's seen as like it might be a little bit risky, but you would be adequately diversified in that asset class, right? So so mutual funds, ETFs, it's a good way to do that. Some differences: mutual funds do have actively and passively managed mutual funds, which basically means there's some person at Vanguard who is like making all the decisions, changing the percentages here and there. And if he's actively doing that, they tend to carry a little bit of a higher fee. They tend to be like 0.0x% fee for actively managed, and sometimes even like 0.1% fee or something like that. But actively managed mutual funds do charge a higher fee. Passively managed mutual funds tend to charge less of a fee. And ETFs charge, from what I use, as far as like some of the ETFs that I have, charge even less of a fee, right? So I think, if you were to say pick one right now, I would probably choose ETFs because I understand that like I don't necessarily need active management. I just need participation for a long period of time, and I would rather incur less fees. So I tend to go on the side of ETFs, but that's me, right? Another small difference, for what it's worth, is like ETF price can fluctuate during the day. But mutual fund price doesn't fluctuate throughout the day. You put in an order to buy a mutual fund and the next day it's bought, right? And it shows in your account. So if you subsequently also decide to sell a mutual fund, the cash won't reflect in your account right away. It'll reflect tomorrow, or it'll reflect the next business day, right? So, I mean, just a small thing, but anyways, that's the difference between a mutual fund and an ETF. But overall, broadly, what are, mutual funds and ETFs, right? So now you know. These are all fantastic investments that you can use towards saving for retirement. How do I save for retirement? That's the next question. I'm good at these segues. I'm crushing it, right? How do I save for retirement? Very basically, spend less than you make. Take that excess, forget it ever existed, and put it in a brokerage account and invest it. And then you never touch that money until you retire. And then when you retire and you don't have any income, you start living off of the money that you saved. And over time, it will have grown significantly and you are now able to retire. That's the very easy way to put it, right? Just spend less than you make, right? And that is hard. That is very hard because a lot of people just flat out don't make enough money, right? Like whether it's the job they work, whatever the case is, the money that they are paid for their time is not enough to live the bare necessities, right? That's hard, right? Some people you just don't make enough, right? And that sucks. But that is a turning point. That is the opportunity where okay, you need to make your time more valuable, or you need to downgrade the cost of living. Now you can only downgrade a certain amount. So that means that you have to kind of make a threshold amount, right? That's beyond the scope of this video. Either a topic for another video or whatever, but essentially assuming that you pass that threshold of the base living, right? Not living extravagantly, just making all your meals at home, staying in on weekends, whatever, right? And you have a income that goes up, that gap is how much you can save for retirement. Now, depending on how fast you want to get there, some people within the FIRE movement, the financial independence, retire early, try to maximize the gap between how much they make and how much they spend on an annual basis, right? Some people are able to save as much as 50% of the amount of money they take home, right? So if they take home, $2,000 and their expenses are $1,000, they're saving the other $1,000. Right? So they're literally living on half of the money that they take home every year, right? I am one of those people, but it's not to say that, that's easily accessible, right? Because you would have to at least make 2x the minimum cost of living, right? Which is not achievable for everybody, right? But I think that's a topic for another video as well. I think FIRE is good and well, right? But I think some of the percentages that they teach are just flat out unattainable. So there's more sustainable ways to do that. But anyways, that's how you save retirement. Spend less than you make, and save the rest. And you use different brokerage accounts to invest that money, which, whether you choose a taxable account, pre-tax retirement account, post-tax retirement account, that's all. If you want it, I can make a video for that. Granted, some of the information may be based on US viewers, but I'm happy to make a video on that as well. So that's how you save for retirement. If you'd like, I also have a financial literacy course that I teach that kind of goes into it a little bit in more detail. So happy to help you there. Start early. Time is on your side. Time is the most valuable asset when it comes to saving for retirement. But anyways, let's move on to the next question. What is credit score and how is it calculated? Oh, fantastic question. All of these are great questions, right? Credit score you can think of as about as a number that is associated with your social security number. And it tells people how trustworthy you are if they were to lend you money for you to pay them back, right? The higher the number, the more trustworthy you're seeing, right? As in our example for bonds, right? It's essentially the credit score agency FICO, rating you super high on that list. So people can charge you less interest on the amount of money that you borrow and be okay with it, right? So you can actually start to get like really good rates when you borrow money from banks, right? But yeah, the easiest way I can explain how it's calculated is by posing it to you, the viewer, as a question. So I'm going to take some pauses after I ask you these questions. Feel free to write what you thought in the comments as far as like your answers, or just write it on a piece of paper or memorize it. I don't know, whatever you want to do. So my first question, if you had no context of who I was, what would you need to ask somebody who has lent me money in the past about me to make you feel comfortable to lend me money? So again, if I'm asking you for money and you can talk to somebody who has lent me money in the past, what questions would you ask them to make you feel more comfortable to give me money? Would you pause the video? Okay, I'm assuming you've paused the video and you've hit play. So questions that you would maybe ask, right? Did he pay you back? Oh my God, yes. Did he pay you back? That's a very important question, right? If you ask them, did he pay you back? And they said no, you are probably not going to give me money, right? There's a reason for that. It's a 100% valid question, and it's actually the highest percentage, like, of the total pie that makes up how credit score is calculated. It's actually weighted 35%, over 1/3 of whether or not your credit score is higher or lower. Do you pay people back on time? Pay people back on time. That's how you increase your credit score, right? Don't have late payments, right? Next question you may ask is, how much money do they still owe you? Fantastic question. Because if I still owe them $50 and I borrow $50 from you, how do you know I'm going to pay you back, right? What if I borrow money from you and I borrow money from them and I only have $50 to my name? Who am I going to pay back, right? Valid. That's actually another thing. It's actually another 30% of the calculation of your credit score. So quick math, 65%, almost 2/3 of your credit score is, do you pay people back on time and how much debt do you currently have, right? Wow, that's easy. So another 15%, I believe. Is it 15%? I think it's 15%. 15%. So length of credit history. So you may ask them like, how long has he been borrowing money from you? And they may say, 2 months. And you're like, well, that doesn't give me a long time horizon to like understand. But if they say 8 years, you might be like, 8 years and you still have a relationship with them. Well, it must be good, right? Bam, 15% there. So now our total is up to 75, 80%, right? 10% is your credit mix, right? Basically, this one is kind of more of like a negative consent, if you will. It's like, basically, if you're not causing red flags, then it's like a free 10% essentially. But does the debt that you're asking for make sense? So if I'm a young 20-something and I say, hey, I need to borrow some money, and you're like, why do you need to borrow money? I'm like, I need to borrow money for investing in housing. And you're like, oh, okay, nice. Let me check, all the different like lines of credit that you have open or whatever the case is, right? How many loans you have out. And you see 30 other people have lent me money for buying houses. You might be like, why is this 20-something-year-old asking for money to buy a house when he's asked 30 other people to, buy houses, right? That doesn't make sense to me, right? If I was a 20-something-year-old asking you for student loan money, right? And then that would make sense, so you'd be like, okay, that makes sense. If I was a 30-something-year-old money asking you for money to put on a home purchase, you'd be like, oh yeah, that makes sense. Does it make sense to them? Essentially, it's like, if I'm asking you for $50, does my reason to you make sense, right? And then another 10% is, sorry, I'm blanking here. Credit mix, and then length of history. What's the third one? Sorry. The amount of new accounts that you have open. Sorry, it's been a while since I've done this. So do you have a bunch of are you applying for a lot of new lines of credit lately? Now, some people will say like, oh, like a hard credit check will affect your credit score temporarily. That is true. Soft credit checks do not. Basically, yeah, anyways. But are you opening a bunch of new lines of credit? So there are studies shown that like people who open a ton of new lines of credit right away, or like within a small period of time, are seen as a higher flight risk for not paying people back. So if you open a bunch of new like lines of credit, it's kind of seen as a bad thing. So it'll reduce your credit score, right? So there you have it. Do you pay people back on time? How much money do you currently owe people? Does the mix of your credit make sense? Have you been applying for a lot of new credit lately? And how long have you been like borrowing money from people, right? So that's credit score and how it's calculated. The final question, we're almost there. How do I create a budget and stick to it? This is a fantastic question. A question that I should probably make a video on separately, but we'll cover it shortly here. You create a budget. I am not a fan of the typical budget where you allocate every dollar of your paycheck. I don't necessarily agree with that. I think it becomes tedious and hard to do. I think that you should plot out the expenses that you need to spend every month to live, right? So calculate your rents, calculate your bills like electricity, water, sewage, whatever bills you pay, right? Calculate all of those. And then also on top of those, calculate like, I would say any subscriptions that you may have that you think are good quality of life boosts, right? So like Spotify's, gym memberships, things like that. Calculate those three things up and see how much it takes for you to live any given month, right? Toss in food and gas, and obviously. So like but I would say like not going out to eat, like more so food to cook at home, right? And then whatever money you're left with at the end of the day, you can spend, right? Also up there in like importance for rent, I put saving for retirement. So for me, a line item just as important to my finances as rent is saving money for retirement. So plot those three, pay those first when you get your paychecks. I would aim to have the next month's worth of like payments being saved for intra-month. So like my first paycheck in February is actually going towards 50% of March's like living expenses. And then my second paycheck in February goes towards the other half of March's payments, so that when I enter the month of March, all of my bills and living expenses are covered for the month, right? And then March's paychecks go to April, April's paychecks go to May, so on and so forth, right? And then sticking to it really is just like, you have to be able to like get comfortable and accepting of a lifestyle that you're going to have to live with that budget, right? A lot of people get into trouble when they're like, oh man, like I really like going out and doing this thing, but like, oh, I just need to save money. So they look at it as like a death sentence, right? Or they look at it as like, you know, a prison sentence, right? And if you look at that, you're always going to feel like the urge to burst out of the budget, right? But anyways, I do think that that's a complicated video, and I'm happy to I did make a video earlier on how I budget in 2023. If you haven't watched that, I recommend you go watch that video. But in a nutshell, how do you create a budget and stick to it? Have a purpose, have a goal for why you're actually setting the budget. Document the first like 3 categories of spending, which if you watch my other video, you'll understand what I mean. But basically the rents, the saving for retirements, the going out for groceries, gas, and then your gym memberships, Spotify, things like that. Document those, set that aside, and then whatever money you have left, like have fun with that money and don't feel any shame with it. I think is how you make a budget and stick to it. So anyways, I hope this video was helpful. It did end up going very long when I was really hoping it wouldn't, but you know what? If you stuck to it to the end, feel free to leave a comment and say, I don't know, stonks, I made it to the end, whatever. All right. If you have any questions, leave them in the comments. Be more than happy to answer them. But without anything else to say, hope you all have a wonderful night. Take care. I'll see you next time.